But let's now get to, India's macros, because as promised, Latha is now joining in to talk about India's current account surplus. And it's a surplus, Latha, for the first time in 10 quarters. What led to it and what's the outlook?
Yeah, first, what has led, why it is a bit historic. We've always had a current account deficit as a burden on the economy. In 1991, it led us to, possibly defaulting on IMF loan and collateralizing our gold for that. In 2013, we were called one of the fragile five. So if all those huge deficits are now replaced by a minor surplus, then that becomes very important. It's a surplus of 0.6% for the fourth quarter. For the full year, it's a deficit FY24, but it's a minor deficit, 0.7% is neither here nor there. It's almost a balance. So what caused it? It's primarily the big growth in India's services exports, mostly software exports. They've been doing well. They're doing even better now. So that's a 9% growth in services exports to $142 billion. On the back of this, there's also something called the business process exports that's growing. Those are the GCCs, the global captive centers, which are not software, the non-software global captive centers where, accounts, all the middle office work, accounts, compliance, risk, tax, payrolls, etc. are processed in India for Western economies and developed country companies. So that has grown by about 40%, albeit on a small base. The other big positive is the Indian diaspora, Indians living abroad and remitting money. Now it's over 100 billion getting remitted every year, 105 billion to be precise in FY24 itself, 5% higher year on year, but quarter on quarter it's 15% up. So just look at the pace at which that's growing. The other reason why the current account surplus is good is that the goods deficit, import-export difference has narrowed. Actually, last year, both imports and exports fell, minus 5.3 for imports and minus 3.3 for exports. This is largely price-driven because in 22, prices had shot up for all commodities due to the Ukraine war. And therefore, this is not a volume-led fall as much as a price-led fall. But the important take-home over here is that imports are falling. At a time when India could easily pay for imports, Indian industry was not able to absorb so much imports. We need to grow faster because now we have the wherewithal. So you could count that as a bit of a negative. The other negative is the FDI flows. FDI flows in FY24 is 1/3 of what it was in FY23. Again, representing that, you may be a great investment opportunity, but the world is not yet waking up to it. What does a current account surplus basically mean? It means we have exported our surplus. At a time when domestic industry has yet to pick up, when we have a long way to go in terms of the growth story, you'd rather not have that surplus, but have a minor deficit so that investments flow into India and not the other way around. So to that extent, current account surplus clearly signifies that the external constraint, the deficit, the twin deficit that we used to speak about, one of them is well and truly over. It's for us to make it and to use the opportunity of the surplus in terms of higher imports and higher capex.
Okay, thanks, Latha, for that.